Something happened in the last few days that stopped me cold. I was going through a stack of financial reports, the kind of stuff most people never read, buried in PDFs and press releases, and I came across a number that I had to read 3 times before it actually registered. Not because it was confusing, because it was that significant. What this number represents is not just a story about silver. It is a story about a fundamental change in how ordinary people around the world are thinking about money, about safety, about where to put their hard-earned savings when everything else feels unstable. What I am about to walk you through goes several layers deeper than what you are hearing on financial news channels right now. By the time we get to the end of this, you will look at your own financial decisions differently. Before we get into it, if you found Element Axis because someone shared this with you, or because you searched for real silver analysis that does not talk down to you, hit that subscribe button right now. We do not do hype here. We do not do fear-mongering. We read the actual institutional reports, we dig into the supply chain data, and we connect dots that most channels either miss or ignore. One click keeps you in the loop on everything we cover. Now let us get into this because there's a lot to unpack, and every piece of it matters. Over the past 48 hours, 3 separate stories surfaced in the financial world that, when you look at them individually, each one is interesting. But when you lay them side by side and read them together, the picture that emerges is something I have not seen in the silver market in a very long time. Maybe ever. The first story comes out of Southeast Asia, from one of the most respected banking institutions in that entire region. The second is coming directly out of China, and it involves something that should be sending alarm bells through every commodity desk in the world. And the third is about what is happening to silver prices right now, and why the way the mainstream financial press is framing the current price, action is not just incomplete, it is actually backwards. I want to take you through each one carefully and then show you how they connect, because the connection is where the real insight lives. So let us start with the first story. A major bank in Southeast Asia, one of the largest financial institutions in that entire part of the world, just released their precious metals investor data for 2025. Banking institutions do not release this kind of internal data very often. When they do, it is because the numbers are significant enough that they want the market to know. And trust me, these numbers are significant. According to the official announcement published on February 16th of 2026, the total number of precious metals investors at this bank grew by 2.5 times in a single year, 250% growth. In 12 months, at one bank, in one country. I want you to sit with that for a second, because there's a tendency when we hear large percentage numbers in financial news to let them wash over us without really processing what they mean in the real world. If you walked into a grocery store and the number of customers buying a specific product grew by 250% year over year, every analyst, every supply chain manager would be scrambling. That kind of demand growth breaks existing supply infrastructure. It reshapes entire industries. And it happened in the precious metals investor base at one of Asia's largest banks in 12 months. But here is where it gets even more interesting. And this is the part most coverage completely glosses over. This growth did not happen because silver and gold were cheap. It happened while prices were hitting record highs. Think about that. Standard economic theory tells us that when prices rise, demand falls. Higher cost means fewer buyers. That is Economics 101, except that is not what happened here. According to the bank's own data, even as precious metals prices were climbing to new records, the number of new investors continued to increase. In fact, toward the end of January 2026, month-over-month growth in new precious metals buyers was tripling, at record high prices. That is not normal price-sensitive buying behavior. That is conviction. A belief so strong it overrides the natural hesitation that comes with buying something near an all-time high. And when you see that kind of conviction-driven buying from a large and growing group of first-time investors, you are looking at something structural, something that does not reverse easily or quickly. The breakdown of who these buyers are is where the real long-term story lives. Pay close attention here, especially if you are in that 45 to 55 age range, where you are thinking seriously about the next phase of your financial life. According to the bank's data, the number of investors under the age of 40 doubled in 2020 compared to 2024. People under 40 now make up half of all precious metals investors at the bank. Half. But the most striking figure is this. The fastest growing group of all, the segment showing the most aggressive increase in both the number of investors and the size of their holdings, was people in their 20s. Drop a comment below if this surprises you. I genuinely want to know if it matches what you have been observing. Because for a lot of people who have been in the precious metal space for a long time, the idea that 20-somethings are now the most aggressive silver buyers at a major bank is going to feel counterintuitive. We grew up thinking precious metals were for older, more conservative investors, people who wanted to protect what they already had, not people just starting out. But the data is telling us that perception is outdated. Here is why it matters structurally. beyond the feel-good story of young people being financially responsible. When someone in their mid-50s buys silver, they might hold it for 15 or 20 years. Their investment horizon has a natural ceiling set by retirement planning and life stage. But when a 24-year-old buys silver as their very first investment, that metal could sit in their portfolio for 40 years or more. The bank highlighted a specific example that illustrates this perfectly. They profiled a young woman in her mid-20s who made her first ever investment 3 months ago. She started with the equivalent of about $1 in paper silver through the bank's mobile app. Then, over the next few transactions, she added more, building up a small but growing position. What she said about why she chose silver over stocks or ETFs captures exactly why this generation is moving into precious metals. She said she felt encouraged watching the value of her investment grow, but even if it had not grown, she felt reassured knowing precious metals hold their value over time in a way that individual company stocks simply do not. A company can swing wildly based on news, earnings, market sentiment. Silver has been a store of value for thousands of years. She also said something important about how this generation thinks about investing. As a new full-time employee without a lot of capital, buying a single share of an S&P 500 ETF feels expensive. But buying precious metals in small fractional amounts lets her start building something real from the beginning, even with very modest money. That is the fractional buying revolution, and it is changing everything about how new investors enter this market. The bank allows customers to purchase paper gold or silver from as little as 0.01 of an ounce. In practical terms, that means you can start investing in silver for roughly $1. The barrier to entry has been essentially eliminated. And what happens when you eliminate the barriers for an asset class with a 5,000-year track record of holding value? Millions of people walk through that door. They are walking through it right now. If you find this kind of analysis useful, share this video with someone who still thinks precious metals are just for people who distrust paper money. The data from this banking report alone should change that conversation. Now, let me shift to the second major story because this is where things get complicated in a way with very serious implications for silver prices going forward. We have established that demand from new investors is surging across Asia. Now, let us talk about where that silver is supposed to come from. Supply does not expand overnight. You cannot open a faucet and get more silver. And right now, in the world's largest silver-consuming nation, the supply situation is tightening in a way that should concern every investor paying attention. China is experiencing what analysts are calling a silver supply squeeze. A supply squeeze means the available inventory of silver, the stockpiles sitting in warehouses and vaults that act as a buffer between what mines produce and what industry and investors consume, is shrinking. Not just declining gradually, draining. And this is happening because two massive forces are hitting the Chinese silver market simultaneously, both pushing in the same direction. The first force is industrial demand. China has become the dominant player in several key technologies that require significant amounts of silver. Solar energy leads that list. Each solar panel requires silver in its photovoltaic cells. When you're talking about thousands of square miles of new solar installations, the silver demand numbers become staggering. Electric vehicles require silver in their electrical systems. Semiconductors and advanced electronics require silver in their circuitry. Fifth-generation wireless infrastructure requires silver. The industrial demand from China's manufacturing and technology build-out is enormous, and it is not slowing down. Here is the critical point about industrial silver demand. When a solar panel manufacturer needs silver to complete a production run, price is almost irrelevant. They need it, and will pay whatever the market asks. You cannot substitute another material in a photovoltaic cell without compromising performance. Industrial silver demand is what economists call inelastic. The factories need silver and they buy it regardless of cost. Add to that the second force, investment demand from Chinese citizens. China's domestic economy has faced significant headwinds. The property market, where the majority of Chinese household wealth was historically stored, has been under severe stress. Investors who watched real estate stagnate or decline have been looking for alternatives. Currency concerns have driven capital toward hard assets. Geopolitical uncertainty has increased the appeal of something that does not depend on any government's fiscal health to hold its value. Millions of Chinese citizens have been moving money into gold and silver at the same time the industrial sector is consuming silver at an accelerating rate. The result is exactly what you would expect when two massive demand drivers hit a finite supply simultaneously. Stockpiles are being drawn down. The buffer between production and consumption is shrinking. And when that buffer gets thin enough, buyers start competing more aggressively for whatever physical metal is available. That competition shows up in the premium. The difference between what you pay for actual physical silver and what the paper price says it should cost. Right now in Shanghai, physical silver premiums have been elevated for months. Chinese buyers are paying above the published price to get actual metal. The market's way of saying the official paper price does not reflect the real-world cost of obtaining physical silver. Leave a comment if you have been watching the premium dynamic in your own research. It is one of the most underreported aspects of the current silver story. Now, let me connect these two stories, because the connection creates something very few analysts are discussing openly. We are looking at a feedback loop, and feedback loops in commodity markets can be self-reinforcing in ways that accelerate price moves much faster than most models predict. Here is how it works. New investors across Southeast Asia, prompted by accessible platforms and a desire to own something real, are buying silver through digital banking apps. That creates buying pressure on the physical silver market. The most natural source of supply in the Asian region is China. But China's own domestic demand is already consuming silver faster than the country can produce it. When additional demand from across Southeast Asia adds to an already strained supply picture, it accelerates stockpile depletion. Lower stockpiles push premiums higher. Higher premiums signal to global markets that physical silver is becoming genuinely scarce. Scarcity attracts more buyers. More buyers drive more demand. More demand drains supply further. The loop reinforces itself. What makes this loop particularly powerful and hard to break is that global silver mine production has been essentially flat for years. We are not in an era of significant new silver discoveries. The major producing countries have been extracting silver from deposits in operation for years, sometimes decades. New mines take 7 to 10 years to move from discovery to meaningful production. You cannot solve a supply crisis in 2026 with a mine that will not produce until 2033. The supply side has very limited flexibility. What happens when demand is rising, supply is constrained, and the only mechanism to balance the market is price? Prices have to move. And given that industrial demand is inelastic, the adjustment has to be substantial. That is the mathematical reality of where supply and demand are positioned right now. I want to address something the financial media is getting significantly wrong. Over recent weeks, there has been a period of stabilization in silver prices. After considerable volatility, prices have settled into a range. Some coverage frames this as if the rally is over, the implication being that investors who were watching missed their window. Stabilization after a significant move higher is not the same thing as a top. In the history of major commodity moves, the stabilization phase following an initial leg higher is often where the most important accumulation happens. Conviction buyers add to positions. Less committed investors who got spooked by volatility step aside. The market builds what analysts call a base, a foundation of buying support at elevated prices that becomes the launching point for the next leg. Think of it like hiking a steep trail and reaching a flat section. You stop, catch your breath, check your map, then keep going up. The flat section does not mean the trail is over. It means you are preparing for what comes next. That is what silver is doing. Consolidating, building a base at higher prices than 6 months ago. And the fundamental reasons it moved higher, the demand surge, the supply constraints, the generational shift in investor behavior, none of those have reversed. The detail from the bank's data I find most compelling is this. In January of 2026, the month immediately following a sharp silver price decline, new investors buying precious metals tripled month over month. After a crash, the price dropped, and the response was not panic or hesitation, it was accelerated buying. People looked at the lower price and treated it as an opportunity. That is the most bullish possible demand signal in any market. When investors respond to a crash by buying more aggressively rather than pulling back, conviction is deep, and the investor base is growing in a way that makes it resilient to volatility. Hit the like button if you have been noticing this buy the dip mentality in the silver community around you. Now I want to spend time on the generational dimension, because it is one of the most underappreciated structural shifts in the precious metals market in decades. Many of you grew up in an era when precious metals were for a specific kind of investor, defensive, conservative, for people skeptical of the financial system or wanting to protect wealth already accumulated. Younger people were supposed to be in growth assets, stocks, real estate, mutual funds. The idea was that with time on your side, you could take risk, and you shifted toward safety as you got older. That framework is not entirely wrong. But the bank's data suggests the younger generation has arrived at a fundamentally different understanding of what precious metals represent. They are not seeing silver as a defensive asset for cautious retirees. They are seeing it as a foundational asset, a base layer that sits beneath everything else in a portfolio, something real, scarce, and proven in a world where everything else feels manufactured and fragile. The young woman profiled in the bank's announcement said it better than most analysts could. She is not buying silver because someone told her it was safe. She's buying it because she intuitively understands it holds value across time in a way that a company's stock simply does not. A company can go to zero overnight based on headlines and sentiment. Silver has held value for 5,000 years, and she is buying it first. Before stocks, before ETFs, before any other asset. She is laying a foundation of real assets before building anything else on top. That is a profound shift in how an entire generation thinks about wealth building. And what it means for the supply side is equally significant. Every ounce a 24-year-old buys today and holds for 40 years is effectively removed from the market's available supply for a generation. Multiply that across hundreds of thousands of new young buyers, and the effect compounds meaningfully over time. Let me also address what a senior official at the bank said publicly, because it reveals how the institution itself thinks about where this market is headed. The head of wealth management used one specific word when describing the forces driving gold and silver prices higher. She called them structural factors. Not speculative, not temporary, structural. That word means these forces are embedded in the fundamental architecture of the global economy. They do not reverse when sentiment shifts. They do not disappear when headlines change. She also told young investors to build positions gradually, take advantage of price dips, and stay focused on long-term goals rather than reacting to short-term noise. That is not the language of someone telling you to sell. That is the language of a long-term accumulator. Share this video with someone in your circle who has been on the fence about silver, not because we are telling people what to do with their money, but because they deserve access to analysis that goes deeper than standard financial channels. The bank data is real. The China supply data is real. This is built on institutional reports and documented market dynamics. Now let me bring this all together, because the synthesis is where the picture becomes clearest. What we are witnessing in the silver market right now is not a speculative bubble. It is not a meme-driven moment. It is a convergence of structural forces coming together simultaneously from multiple independent directions, all pointing toward the same conclusion. On the demand side, something is happening that has never happened before in the history of the modern precious metals market. An entire generation of young investors choosing silver as their first investment, not after building wealth elsewhere and wanting to protect it, choosing it first as the foundation on which everything else gets built. A fundamentally different demand dynamic than this market has ever experienced. And it is happening at scale across a region containing the majority of the world's population, through digital platforms that have eliminated every traditional barrier to entry. On the supply side, the world's largest industrial consumer of silver is facing a documented and deepening squeeze. Stockpiles are being drawn down by the simultaneous pressure of relentless industrial demand and surging investment demand from Chinese citizens. Physical premiums in Shanghai are elevated, signaling that the official paper price is lagging behind what the real-world physical market reflects. Global mine production cannot respond in any meaningful time frame. On the price side, a consolidation pattern is forming after a significant move higher, which, based on the fundamentals and on institutional demand data, looks far more like a base for the next leg up than a top. Threading through all of this is something worth naming clearly. The mainstream financial media is either not connecting these dots or choosing not to. A major Asian bank's precious metals investor base growing 250% in 12 months should be front-page news. China's silver supply being squeezed by simultaneous industrial and investment demand should be leading discussions on commodity desks everywhere. Instead, coverage has been thin and framed in ways that minimize what is actually happening. Most investors are making decisions about silver based on an incomplete picture. Incomplete information leads to incomplete positioning. When the next leg of this move materializes, a significant portion of the market will be either underpositioned or not positioned at all. For someone in the 45 to 55 plus range, thinking seriously about their financial picture over the next 10 to 15 years, the data points to something worth careful consideration. Silver's role as a store of value is not theoretical. It is documented across thousands of years. The argument that precious metals hold value when currency purchasing power erodes, when equity markets go through volatile stretches, when real estate stagnates, that argument has not weakened. The macro environment of recent years has only strengthened it. The structural forces driving silver demand are embedded in technology, in the global energy transition, and in the behavior of an entire new generation of global investors. These forces play out over years and decades, not quarters. Drop a comment and tell me what piece of today's analysis hits hardest for you. The demand surge from new Asian investors, the China supply squeeze, the way institutional leadership described these forces as structural, or something else? I read every comment, and the conversations in that section consistently produce insights that go deeper than what you find anywhere else on this topic. Here is what I want to leave you with. One of the most striking things buried in the bank's announcement is a single word choice. They did not describe what happened to their precious metals investor base as a spike. They called it a shift. A spike implies something that goes up and comes back down. A shift implies a permanent change in the underlying structure. The behavior of investors has shifted. The mental model that young people bring to their first investment has shifted. The way an entire generation thinks about precious metals has shifted. These are not temporary fluctuations. They are changes in the foundation. 3 months ago, a young woman opened a banking app and spent the equivalent of $1 on silver, her very first investment. Not in a company, not in a fund, in silver. She is now a precious metals investor. She is going to watch that position, add to it, and carry that experience for the rest of her financial life. Multiply that story by the hundreds of thousands who entered through similar platforms in 2025, and then multiply it again by the millions who will follow in 2026 and beyond, because the infrastructure that makes it possible to buy silver for $1 on your phone only gets better and more widely adopted with time. That is the generational shift the data is describing. And when you layer it on top of a supply side that is already strained, already showing premiums above the paper price, already drawing down stockpiles faster than they can be replenished, you get an equation pointing in one direction with considerable force. The question is not whether silver prices eventually reflect these dynamics. They will. The laws of supply and demand have not been suspended. The question is whether you understand what is happening in time to be positioned before the mainstream financial world catches up to what institutional data is already showing. At Element Axis, that is exactly what we are here for. If this gave you something to think about that you were not thinking about before, subscribe now, because the next piece of this story is already developing, and we will be right here following every detail as it unfolds.